recent report from Stifel GMP analyst Justin Keywood on Well Health Technologies, ticker symbol WELL on the TSX, characterized where the company is right now. And the analyst was more than bullish, saying, quote, Well is unique as a healthcare services and technology company with multiple levers to drive growth, while maintaining his buy rating on Well and a one-year target price of $13.50, which at press time represented a projected return of 331%. We catch up now with CEO Hamed Shahbazi, a recent recipient of an EY Entrepreneur of the Year Pacific region, to talk about where Well Health is on its journey. Hamed, good to see you. How are you, sir?
Great to see you, Richard. Thanks for having me.
Hamed, you recently reported some great results for your third quarter and increased your guidance to reach $700 million in revenue by the end of 2023 for a business you started just 5 years ago. That's phenomenal growth. Can you tell us what's driving the growth?
Yeah, thanks, Richard. We indicated that by this time next year, basically by the end of 2023, fiscal 2023, and we're on a calendar year end, we'll be approaching 700 million in revenue. And what I'm really happy about is just how we've been able to consistently deliver operating EBITDA margins, strong margins, as well as organic growth. So over the past year, our organic growth has accelerated and it's now just shy of 20%. And we've been maintaining good, strong margins. We've been really meeting and exceeding our guidance consistently. We've done 4 straight beaten raises. So we're very constructive on the future. In this environment where there's so much demand destruction happening by the Fed, I think healthcare is a fantastic place to be, a great asset class, and our team is executing.
You made some acquisitions, and I'm wondering what the acquisition pipeline consists of. Are you looking at buying more clinics or more software companies? Like, where are you finding value in the market right now? Canada, the United States? What are you looking at?
The pipeline looks very strong, and I think that's a feature of today's environment, and the fact that we have been successfully allocating capital over the last several months, and so many people have stopped because they're in a difficult situation with cash, and we continue because of our strong cash flow and credit availability with very high quality lenders and good cash position. We're in a position to continue to take advantage of opportunities. And so both in the US and Canada, we have opportunities. We've transacted both in the US and Canada over the last several months and are continuing to look at opportunities. And I think generally speaking, we're focused on care provider rich businesses. So we're looking for opportunities where we can have greater exposure to care providers that can benefit from our technology. And that's really the whole big idea with Well is, we have a great technology platform. We have a great technology DNA. Providers need that. Providers need, to transform their businesses, especially in this environment where it's very important to be more efficient. And unless they integrate technology and software and workflow into their operations, they're just not going to see the type of efficiency that's going to get them through this environment. And so we're highly encouraged because not only are we still able to allocate capital, but we're really able to help providers. I mean, at the end of the day, that's all that matters. And if your core business idea works, and our core business idea is, can we tech enable providers? Can we help them run a better business? And we're seeing that the answer is yes. So that's why we want to allocate more capital and acquire more provider-rich businesses, and then basically help make them better and create that alignment with providers, so that both providers and Well win at the end of the day. And that's what's happening. So yeah, we have a good long watch list, and while we've taken our multiples down, and we've become even more disciplined. We've always been highly disciplined, which means that we'll probably be transacting at lower multiples, but we feel very good about our opportunity to do that.
Everyone has seen the challenging macroeconomic headlines in the news regarding high inflation, recession risks, and rising rates. How is Well handling the current macroeconomic environment?
Yeah, it's no doubt very difficult. Of course, in this hyperinflationary environment, we can see the Fed has been making big rate hikes, successive rate hikes now for several months. And of course, the Fed can't create more supply in the marketplace. So the only thing they can do is destroy demand. And that's what these hikes are designed to do. And so I think it starts to create an environment where companies react in a very different way depending on whether or not they're discretionary or non-discretionary spend. And being in healthcare, I think, is one of the best places you can possibly be because it is non-discretionary. If you need care, you need care. And so, and depending on the payer model, some of these rising costs may not even impact the consumer as much. And so we're, as you can see from our numbers, we're actually seeing, good, strong organic growth, probably the best organic growth we've seen for a while now. So we're very constructive on the market. It has resulted in some of our costs being higher, which is, to be expected given that all costs are pretty much higher. And we did experience a shortage in healthcare workers, but our team has done a fantastic job working around that and delivering results.
Yeah, I mean, clearly Well's in a good spot. The numbers, as you say, look great, but I'm wondering as well, Hamed, what 2023 looks like. What are the catalysts to drive the company next year? What are you looking forward to?
There are risks in the marketplace. We know that there's things that can come up, but we still feel very good about maintaining our organic growth. Again, within the context of that rule of 30, that's really important because, of course, there can be some interplay between profitability and growth. Sometimes you may have a little bit more growth and that affects your profitability. And sometimes, your profitability will be a little bit higher because you didn't invest as much in growth. So that's I think going to be key for us. I think you're going to continue to see us allocate capital, but certainly at a different pace than we did in the sort of 2 years from 2020 to 2021. 2022, you can see we indexed down that a little bit. But look, we're continuing to find great deals. I think that's one of the quote unquote gifts of this time, of this marketplace that we're in, is the fact that we, it allows us to find some incredible opportunities where we can be relevant and we can help providers. And what we're seeing more and more because of all these challenges that we've talked about is care providers are looking for professional management for their businesses. It's becoming increasingly difficult to be a care provider and be someone who runs a business and takes care of, administrative burdens and front office challenges and things of that nature. So Well's got a really, I think, supportive and important platform in terms of being able to come in and, helping with the front and back office, with our technology, or just being in a position to take over the whole thing in a fully managed environment.
Yeah, well positioned, it sounds like to me. Hamed, great to catch up with you again, CEO of Well. It's ticker WELL on the TSX. Thanks for joining us. Really appreciate it.
Thank you, Richard. It's great to be with you.